Hello and welcome to the Q1 WFG Industry Perspective. I am Ken Perry with the Knowledge Coop, and I've got the same two guys from last time, because why would we change it up when we have this much brilliance at a table? I've got Pat Stone from WFG. I've got Dr. Bill Conerly. You guys, thanks for coming and joining me again.
Our pleasure.
Great to be here.
I watched the last video we did multiple times. I just loved it because there's so much knowledge out there. There's so much knowledge in your heads that you're sharing that it's kind of fun to just learn again and again and again. So I'm excited for today, especially because things have changed a little bit since last time. Just keeping up with things seems insane. So I appreciate that you guys are going to shed some light on it. And as always, everything they say is exactly true and right, and nothing will ever change, right? We're good?
And if you believe that.
Well, let's start with you, Bill. We'll hang out with you for a little while. We'll jump over to you, Pat, and then we'll just kind of do a round robin. But Bill, the economy's pretty interesting right now. There's seems to be a slowing of economic growth. Is that really a slowing? Is it just a calming down? What's happening right now?
Well, I hear a lot of people who are concerned about it. The actual statistics aren't that bad. Fourth quarter GDP was low, but a lot of that was federal government layoffs and the temporary closure. I'm looking for moderate growth this year in 2026, but it's not going to be as strong as we might have seen. Our population going down. The native-born people are either leaving or the immigrants are leaving, but we're getting a net outflow. So the labor force is not growing like it had been. We will still grow through greater productivity, but the total number for dollars spent and dollars produced will grow at a slower pace because of the limited immigration.
Wow. So you're already seeing the impacts of that.
We're seeing a little bit, but I know there's a lot more to come, and a lot of our data lags. And we know that there have been deportations and very few people coming across the border into the U.S. as they did in the last year of the Biden administration. So that labor constraint will affect some sectors, construction, agriculture, food processing the most, but it will also spread over the whole economy just a little bit. I think the average person maybe won't notice it unless they're in one of those affected industries, but the aggregate numbers will be okay, but not a barn burner.
So we're not seeing a complete dip. We're seeing just a bit of a slowdown is the estimate.
Good point. It's not a decline. It's not a recession. It's just the growth rate is going to be not as strong as it had been a few years ago.
I want to talk for a second about the shape of the economy. So There's like a V and there's a K I just heard about.
People are talking about a K-shaped economy. And the idea behind that is the people at the top are going up, the people at the bottom are going down. Mm-hmm. So it looks like a K. That has an itsy-bitsy tiny bit of truth in it, but not very much. The truth behind it is in the last year, the wage gains for the low-skilled people have not been as big as the wage gains for the high-skilled people on a percentage basis. So they say, well, the low-skilled are not, doing very well. They're actually getting wage increases above inflation, but not as big as what the high skills are. And this is a temporary reversal. We had a big gain for low-skilled work a couple of years ago when labor was really tight, and their wages went very high, and now they're getting less of a gain. So there's a little bit of truth, but generally speaking, I look across the economy, and I'm not worried about the low-skilled people being worse off. They're just not growing as fast this year as the high-skilled people.
When you're looking at numbers, it's fascinating because you have to look at everything. Like everything factors, like even when you're talking about immigration or deportation, you look at, okay, well, does that open up jobs? Does that create more jobs? Do those jobs? You feel like you're looking at everything. With income gains, this is a state-by-state thing in some cases, right? If you look at the minimum wage in the state of Washington, where we're sitting right now, is quite a bit higher than it is just one state over in Idaho. Is that all factored? I mean, obviously, we're working on averages, right? But
well, and this is an important thing for people who work in a particular area. to keep in mind that the national statistics may not reflect what's going on in their neighborhood. But if you put me in any city I've never been to before and say, hey, what's going on here? The first thing I'm going to look at is what's the national economy doing? Because if there's national growth, if interest rates are going down or inflation is going up, that will have the biggest effect. And then there are the local factors dominated by the population movements, which are a little bit sluggish. They don't vary month to month, but Texas and Florida, we know, are getting a lot of gains in the Northeast, and California losing population. So those are the additional things to look at. And a person who's doing business in, say, one particular city, metropolitan area, will do best looking at the national data and then adding in whether people are moving in or out. And that's probably more important than what's in the news headlines, like a new plant opening up or some company doing a layoff, because there's always turnover and churn there. But are people moving into your market area, or are they moving out?
Gotcha. That's a fact. That's a big factor.
Yeah, keep that in mind. That's what I call a back pocket idea. Stick it in your back pocket and you can pull it out years later.
I was in Orlando last week. Before that, I was in Atlanta, and I am now in the state of Washington. And I noticed the gas prices are quite a bit different in each of these. And I know that raised some anger with people when the statement was made recently that gas is in the twos somewhere, and it is in most of the country. We're like $4.59 or something like that for a regular. So that also would impact a region, right?
Yeah. And we see a little bit of a change in the composition of business there, but that is slow to change. I do some consulting work for a manufacturing company, and there's some particular, in Oregon, and there are some particular things that have gone against them in terms of state policy. But they think about moving. They have skilled workers who like where they live, and so businesses are not moving too much. Mm-hmm. But a competitor who's in a more business-friendly state will grow faster than my client in Oregon, just because the numbers are a little better for them.
Mm-hmm. Interesting. Yeah, they're working on a millionaire's tax in Washington State right now, which is pretty controversial.
Right. I guess you're against that.
It's the S corporation part that's a problem, because S corps don't actually keep all their money. It's the pass-through revenue. Yeah. So I hope that they can figure that out.
Right.
But it is interesting watching how much policy can actually impact economy.
Yeah, and at the national level, certainly things like the tariff change, the immigration change are having noticeable effects on the overall economy. And I don't want to get political here, but I would just like the policy changes to go on hold and keep where we are so businesses can plan for the next few years.
What are the impacts of uncertainty? Like, sometimes you get this uncertainty and nobody knows what to do. Is there like a freezing right now of like, I'm not spending, I'm not saving, I'm like, I don't know what to do right now?
I hear this in anecdotes. I have done academic research on the effect of uncertainty. It's hard to find a dollar effect of it. Other people have done it. I thought, oh, maybe these guys are better than I am at academic research. They have trouble identifying the dollar impact. But I talk to enough people who are delaying decisions. And if you delay decisions enough, that's less spending, less investment, less hiring. So I think it has an effect, but it's hard to quantify.
Gotcha. One of the big changes we've seen is, or are about to see potentially, is we've got a new Fed chair.
Yeah.
On the way, maybe, depending
Probably.
on what time people are watching this, but it's looking like it's going to happen, right? The one's been nominated. We'll see if that gets through. But there's a lot of talk of, will this guy come in and immediately just start attacking interest rates? And obviously the short-term interest rates, but what do you think there?
Yeah, well, Kevin Warsh, nominated by President Trump, he'll have to be confirmed by the Senate. But then the actual decisions by the Federal Reserve are a committee process. 12 people vote, and Warsh will have to convince them to cut interest rates. And right now they are looking at inflation being stubborn, and they're saying inflation is above our target. We need to get down to the target for the long-run health of the economy. And the people who are worried about inflation are thinking long-run health of the economy, and I'm with them on this. But what Warsh may be able to, the argument he may be able to make is one that Alan Greenspan made almost 30 years ago. Inflation was running high. People at the Fed wanted to raise interest rates, and Greenspan said, I think there's more productivity growth than the official statistics are showing. And he talked the Fed into not raising interest rates and eventually cutting rates. And he was absolutely right. Productivity did surge, the economy improved, and the lower interest rates matched the higher productivity. And Warsh may be able to say AI is improving productivity. We need to keep demand up in pace with supply. But I think it's going to be a hard sell. The most optimistic you could be on falling interest rates is the Fed doing a couple of quarter-point cuts just to throw a bone to the White House and maybe deflect attention. But my best estimate is zero changes in short-term interest rates this year.
I love how you actually spelled that all out, because I know that a lot of people hear, oh, he's going to put this guy in and he's telling him, now you get in there and you lower rates. But it's not just him walking in there and lowering rates. It's a committee that has to make that decision. I love that you pointed that out, because then it's not a guarantee we're going to see those rates drop. On the 30-year rates,
Right.
Those have...
We got good news.
Yeah.
Yeah, right, yeah.
What happened? I mean, why are we down there, and will we continue?
Good question. One fundamental point that's worth making is that when the Fed changes interest rates, they're changing short-term interest rates, not necessarily mortgage rates. Mortgage rates, the mortgage-backed securities that drive home mortgage rates, compete with Treasury bonds, 10-year Treasury bonds, corporate bonds, and it's a global market. So we have seen a drop since the first of 2026. We've seen a drop in long-term interest rates in the U.S., in Canada, Germany, France, the UK, Mexico, Canada, not Japan, but this is a global phenomenon where you think of global savings, global demand for loans. And global savings got a little bit stronger than global demand for loans in the last month. So long-term interest rates have come down, and that's why our mortgage rates are down.
There's also a significant decline in the spread between the 10-year and the 30-year.
Yeah.
And that is back to more of a normal range, like 1.6 to 1.8%. It was running over 3% for a long time, which has
Right.
made mortgage rates artificially high, if you will.
Yeah, and that's a good point, because what a home buyer pays in a mortgage rate is a combination of these long-term global interest rates, but also the investors. Do they want to hold mortgage-backed securities, or would they rather hold a regular bond? And with the mortgage-backed securities, like a year or two ago when you were talking about this a lot, the investor said, hey, interest rates will come down and these people will prepay their mortgages, and I'll have to reinvest my money at low interest rates. So I think there's less worry about that, and that's why we've seen this spread come down. And I think it may have another 10 or 15 basis points to go. What do you think, Pat?
Maybe get down 1.5. Yeah.
Yeah, well,
Spread.
yeah.
So,
One and a
no, on the spread between the 10 and the 30 year.
It's like,
Right.
you're talking about
Don't
30-year
get
fixed
excited.
rates. I'm like,
We don't-
you heard it here first.
spread
Pat
between the
Stone
10
says it's going to get down to 1.5% interest rates, 30-year fixed for sure.
Oh, gosh. The spread between the 10-year T-bill and the 30-year fixed rate mortgage may get down to 1.5%.
What could make it? I mean, what, as far as the long-term interest rates, what is there anything globally you see that could cause that to change? Like, because I know that it's a big deal here.
The thing that would, do you mind if I answer?
Go ahead.
And then jump in, Pat.
Okay.
And you can tell them why I'm wrong. But the thing that most brings down interest rates around the world is recession. Interest rates go down in a recession. But that doesn't mean that if you're in the real estate business, you should want a recession, because the effect of people losing their jobs has a bigger impact on home sales than lower interest rates. So, if you're rooting for one thing or another, you have to root for people to have jobs, but that makes it hard to root for lower interest rates at the same time.
What about other global shakeups that could do this? There's talk around Iran right now. There's some concerns, just globally. Mexico just had a huge issue with the cartel situation. Do we worry, or do you see that potentially triggering some more movement in our economy?
Yeah. One of the pieces of data I look at is a survey of what economists on the ground in different countries around the world are saying about their own local economy, the people who know Germany or Mexico or Brazil better than I do. And they're pretty stable in the aggregate. Some of them are more optimistic, some pessimistic, but they average out for fairly steady growth. But the monkey wrench, tariffs and what's going on with trade policy is one monkey wrench for the global economy. And then I always turn to the Middle East. If there's going to be a global calamity, oftentimes it starts in the Middle East, but I'm also a little worried about Taiwan and China. So a major war could have a terrible effect on the whole global economy, but I don't know how to forecast that.
Right. Well, and that's one of the hardest things about being an economist, right? Is you can make these statements and then all of a sudden something happens. You're like, whoa, what just happened? And everything could turn.
There are days when I think I should have studied foreign relations, and other days I should have studied psychology, and then I'm going back to, maybe I should have studied golf.
Out of curiosity, Bill, and not to get off on a tangent, but I'm just curious what your feelings are about the debt, the national debt. Is that going to keep our rates from coming down meaningfully?
Well, Pat, it has not yet. And it's high, and people are worried. The projections are it gets worse. I don't think there's anybody in Washington, D.C. who cares about the national debt, and they should. They should. I think at some point it will. But what we've seen when other countries run into debt problems is the debt gets worse and nothing happens. Gets worse and nothing happens. Gets worse and nothing happens. And then suddenly, and the country's in a crisis. And nobody... You don't see signs of it. It's not like interest rates start creeping up in anticipation of it. It's like suddenly it just goes to heck.
Yeah, we're paying over $1 trillion a year in interest on our national debt.
Is that just you?
Yeah, we should get a refi. That's just what's weird is I think growing up, I don't remember much from elections, but what I do remember growing up is you had all the commercials back when we watched commercials. Remember that? And there would be these commercials, and every president that ran was talking about the national debt. It feels like it was just a big thing, and then now nobody seems to talk about it as much.
And it's a much bigger thing now than it ever was then. All right.
Is it because nobody has a solution for it? It's just...
Yeah. Nobody in Washington has a solution that's politically viable, and the voters around the country have not made that a major issue. So we'll just keep going.
See what happens. Keep borrowing. All right. Let's talk about, speaking of borrowing, affordability in housing is a bit of a problem right now. My daughter's actually looking at, her apartment came up on the lease renewal, and they came in and said, the maximum we can raise your rent is 10%. And so we're going to be super nice and raise it 9.8%. That literally was the letter. And so she's looking around like, I don't even know what to do. Like, so apartments are all going up. Housing seems like it's paused just a tiny bit, and you can speak to this too. It seems like it's not on as high of a rise. Am I just what I'm looking at, or is that a thing?
No, that's true. And it has been for the last couple of years. It's been actually one of the things I think is really noteworthy is that personal income growth has actually exceeded inflation and housing price appreciation for the last 2.5 years. Now, how long does it take before that has an impact on the psychology of the consumer? My gut is 4 or 5 years, and then the consumer starts to realize that they are making more money, and they are making more money in relationship to the average cost of living. So that gives people more confidence. Right now, they're still pretty nervous, and rightfully so.
All right. One more question for you, Bill, before we move over to Pat Moore. Forward looking, what should we be looking for, globally, what's going on? What should we be watching so that we can get a feel for whether things are going up or down?
I think that it's probably worth looking at two things. One is jobs, employment. There's a monthly employment report, and keep track of that. It's a little hard to interpret if you're used to watching them in the past because of the low immigration and perhaps out-migration, but watch the jobs report, and then inflation. And these are the things that the Federal Reserve is going to be looking at. So watching these two will help you understand what the Fed is going to do, and it also gives a picture for the overall economy. If inflation continues to be stubborn, their target is 2%, and we're closer to 3 than to 2 right now. If inflation comes down, the folks at the Fed will say, okay, we can cut interest rates. But inflation stays stubborn, look for them to dig in their heels.
Wow. And the jobs report, when you see the jobs report, you've already talked about the impacts of people leaving the country and things like that. When you see the jobs report, if it comes in low, you're always looking at, okay, what just happened? Or is it just like, nope, jobs are low. That means, the following things must happen at this point.
Well, there's kind of a balance of whether you look at the details or the total. And in the last couple of months, the details have said federal government employment was down, and some of that was DOGE, with a time lag, and then the shutdown of the government. But generally speaking, I like to look at the aggregate. I look at the details because I'm the kind of guy who looks at everything. And I think that for the average person, running a business, just look at the headline numbers, read the first paragraph of an article, and that'll probably tell you what you need to know.
Gotcha. On jobs report day, are you always you wake up it's jobs report day, and you get your jobs report pajamas on?
No, I slap myself and say, oh yeah, you gotta do this. But one of the challenges that an everyday business person has is what to pay attention to. And time and attention is the scarcest resource. So I know some people who spend a lot of time reading economics, and I think they spend too much time, if they're not an economist, thinking about the economy rather than their business. So a few key issues relative to your business, and then the rest of it just ignore.
Mm-hmm. Yeah, I think sometimes people are, and this is my own statement, I talk to people who are looking at the market so much, looking for a reason they're not successful. See, look, it's the interest rate. See, look, they're always trying to find the thing that's why they're not doing it, but it's partially because they're spending so much time looking at the thing instead of out there doing the job that they're, that would make them some money and that would make them successful. So you dive too deep into the data, and you start finding reasons that,
Right. And when we were talking about the K-shaped economy, there are some corporate leaders who are pointing to this for their company's weak sales. They're looking for an excuse. Oh, well, low-income people haven't gotten a high raise. And, it's just an excuse. If something goes wrong, I try to point the finger to somebody, and you'll see that in the news.
When I wonder if next year, when we're sitting here doing this for Q1 of 27, I wonder if we're going to see that white-collar worker issue with AI taking out some of those white-collar jobs, and if that K starts to change quite a bit.
Yeah, that's a concern, and I think we can have a whole discussion on AI, but as the simple summary is, the person who's doing plumbing or carpentry has a more secure job than the person writing computer code.
All right, Pat, let's move over to you. Talk about the real estate industry, the housing market. Are we moving in a good direction right now?
We're not moving very much in any direction right now, although I will say this, I think overall the market is as balanced as it's been for quite a while. Supply and demand are somewhat in alignment with each other. You move to different parts of the country, they're different, but basically you are seeing that there's no major extortion by either too many houses for sale or too many buyers and too few houses. It's pretty much in balance right now.
I think we forgot what normal feels like. And so it feels weird because it's normal, but this does seem like the most normal market I think we've had in a while. Is that fair to say?
Well, in terms of the volume and supply, the relationship between supply and demand, yeah, there are other factors that are not very normal, but by and large, I think the amount of activity is probably normal given the circumstances that we're dealing with it. Yeah.
The rate lock-in effect. I just had a conversation with somebody the other day who doesn't believe that 5% is going to move people, or something in the fives is going to move people who have a 3% mortgage on their house. I think I think 5's not far from 3. It's definitely closer than 8 was from 3.
Can I ask a question back at you?
Yeah.
And I'm really asking this to all the people that spend time discussing this topic. How long do people stay in a home? On average, right now, it's a little over 10 years. When did they get the 3% mortgage? 3 or 4 years ago. So why are we even having this conversation? These people aren't selling their home right now. They're not moving right now. It is not a factor right now. I am stunned at the amount of time we spend talking about something that is totally irrelevant at this point in time.
Yeah.
I mean, if you bought a home in 21 or 22 and you have an average, the average American spends 10 and a half years in their home now, maybe in 21 or 31, 32 or 33, we can have this conversation.
And that would be a normal time for them to move anyway.
Yeah.
Yeah. And that actually was the guy's argument I was talking to. He's like, people move when they're ready to move and when they're,
Yeah, regardless of what the mortgage rate is, they move because of a job, because of an expanding family, or some other reason. But people don't move because of mortgage rates very often. That's not really the main reason.
Are you guys seeing more refis come through?
Refis have actually slowed down a little bit. We had a pretty good refi run October, November, December, and even into January, February, they've dropped off. Resales are up nicely, but refis have dropped off.
What about the new construction?
We're running at about a 1.4 million rate right now, so it's still below where it needs to be given the demand. But the average builder out there is concerned. There's too many unknowns. And if you're a builder, you have to look down the road 9 to 18 months. And right now with the level of uncertainty, that's hard to do.
I talked to a builder recently, and I never knew the impact of, or the difference between being a small builder and a large builder. And the small builders can't take the kind of losses the large builders can. And so in a market like this, if the houses aren't moving as fast as they had expected them to, the large builders can take that cut and do a massive sale in a community where the small builders just have to watch it happen. But their margins aren't where they, if you're a builder that's a local builder, that local economy is what drives you. If you're a national builder, you've got other housing markets that might be better for you. And
yes, a couple large builders we do business with are really focusing on certain areas where the market for their product is good, the price range works, and then they've slowed down on areas where it doesn't. So they have that viability. Yeah.
Let's talk mortgage product just for a little bit. The GSEs, we used to have so much product, right? There used to be a lot of different loans, and apparently some of them didn't go so well. But we went to, now we're Fannie, Freddie, FHA, USDA, VA. We expect to see more private securitization, come out. We expect to see more creative types of loans. I know some DSCR stuff have come out where we've got some better self-employed borrower things. But as far as private label, do you see them competing with the GSEs at any time?
There's still a psychological hangover from the financial crisis, which was really precipitated, I think, in large part by Wall Street packaging loans and throwing in a lot of subprime to get the return on the securitized loan up. So I think there's still some reticence on a lot of people's part to go down that road. One thing you are seeing is there is a regulatory initiative to get enable banks to get back into the mortgage business. Banks were doing about 60% of all mortgages prior to the financial crisis. They're down to about 35% of mortgages now. So if you got more banks back into the mortgage market, I think that would make the mortgage market a little bit more competitive and make it possible to have a little bit more fluctuation in product construction type and payment expectations, if you will. So I don't think there's going to be any really new type of products out there. There's not going to be a 50-year mortgage. That's not going to happen. So we're not going to see a lot of that. I don't think you're going to see a lot of private securitization of mortgages. I certainly hope the regulators watch that so that doesn't happen, because that's a death spiral, if you will, in one man's opinion.
Yeah. Globally, we're one of the only ones with a 30-year fix, right? And so looking at a 40 and a 50-year fixed is, I've penciled both of those. And my smartest friends are also penciling these things going, show me how this makes any sense at all. There's no savings. There's not enough savings to justify that you're not paying any of your principal down.
Yeah, exactly. It's very, very expensive. 50-year mortgage is very expensive. One of the things that's different here too is that people in this country move a lot more. And then we also do not have the wide variety of housing types and costs. If you go to Europe, I mean, obviously townhomes are very popular in Europe, and you'll go block after block after block. There's no yard, there's just house after house attached to each other. Much more cost effective, and I kind of wish we would wake up on our zoning and allow for more of that type of construction. I remember back in the 70s, I'm dating myself a little bit, but I remember back in the 70s when they came out with the urban growth boundary for Portland. And I thought, well, this is a great idea. Well, in retrospect, it wasn't, because one of the things that hasn't happened is every time we add to the urban growth boundary, we got to go back and redo all the infrastructure, because we don't build the infrastructure with the idea of the whole thing being used, right? We build the infrastructure for each incremental improvement. So it's not very cost effective the way we have it structured right now. We need to revise that.
I live in Camas, just 20 minutes that way. And they're building now north of Lacamas Lake. They're building like massive amounts of townhouses and houses. And they're putting a Fred Meyer up there. And we're all looking at it going, okay, there's a lake. And there's a side of the lake that has like this much room between another lake. So how are those people all going to get out of that area? So when you say that, it's like, that's exactly what we're dealing with, is how can you build without building that infrastructure out? Then the infrastructure you're going to have to build is going to take out quite a few houses and businesses that are in the way. So it's just that I love the thought of, if we could just think about what we want for the future instead of think about what we want for the right now, we'd probably have way fewer problems.
I think it would help. We do have to have sort of a reset at some point, because this is a very inefficient process on multiple levels.
Mm-hmm. Yeah. It seems like, kind of going back to the concept of normalization of the market, it seems like for the last 3 years, there was a lot of consolidation in mortgage. I mean, we've got a lot of enterprise accounts where one company became part of another company, one company left and completely dissolved, and then those same people end up showing up over at another place. And we've just seen so many mergers and acquisitions. And then it feels like this last year, there's been a bit of a pause on that as well. It's not nearly as much as it was. It's not the rapid pace. You're seeing loan officers go from one place to another still. But what do you think about the consolidation of the industry? Are we done with the major moves, or do you think there's still some more to go?
Well, I personally think there's still some more to go. I do think that the industry got really excited in 21 with low rates. Mm-hmm. A tremendous amount of companies start up. There's a tremendous amount of players out there that are not very efficient. Lenders, realtors, title companies, everybody. And there are too many participants. So one of the issues, I get engaged in conversations occasionally about how do we lower closing costs, overall closing costs. And one of the things that a lot of people don't understand is that lenders, realtors, title companies are all regulated by different entities in different regulatory silos. So the level of interaction between the participants is still minimal, and the process itself is still not very efficient. When I started in this business, it took 45 days to close a deal. That was 51 years ago. Now it only takes 45 days to close a deal. I mean, it is crazy to me. But back to your question, I do think there'll be more consolidation, because a lot of participants are not making money right now and are not going to make money. So there is going to be some consolidation in all three segments of the industry.
Mm. And may I throw in a perspective here? I've seen this happen like in banking, where there's massive banks, but there is always an opportunity for the little guy, because when you're competing with 3 or 4 major corporations, there's one of them that has put in a bad regional manager for a particular area. There's another one that has the wrong product for that particular area. And that's how the little guys make it. They find the weak big guys, and they grab clients, and then the clients are sticky. So there's opportunity, even though there's consolidation.
I agree with Bill. I would characterize it as, if you can figure out a way to differentiate yourself, and a lot of times a small player they can do something a little bit different than everybody else does, and it appeals to a certain segment of the market. So I do think there will continue to be new players, smaller players, big players, but I think the total amount of players is going to go down.
Yeah. I do worry the smaller players. I've got friends in small broker shops, even large broker shops, that are doing just a spectacular job. They care about compliance. They care about doing things right. I also see some of the worst behavior I've seen in a long time, and not just from small players, also from big players. The lack of regulation has caused some of this to spark up again, where it's, a lot of it's in just the compensation. It's not really facing the consumer. But some of it is, just if nobody's watching, we're just going to get after it and do some things. And look, he did it. He didn't get busted, so we should be fine. So I'm concerned about that.
Yeah, I think also, I think you're absolutely right. And then I think I'm also concerned in our industry, our pricing is based on the value of the home, as is the realtor's commission, and as is most of the lending industry's cost basis or revenue basis. So if you think about this, the homes went up 45% in value in the last 5 years, on average. So the prices have closing costs have gone up. We have seen one state regulator, Texas, mandate a 6% decline in title costs. I will be really stunned if we don't see that in more states, because that will be a conversation at NAIC, the National Association of Insurance Commissioners. I'll be surprised if we don't see that in other places. And so I do think there's going to be a real emphasis and need for everybody to focus on operating more efficiently and using AI, if you will, but doing things to operate more efficiently, because I do think the cost structure will be under examination. How impacted it is, I can't tell you. I don't even want to guess, but I do think it's getting attention.
Was that an insurance commissioner that did that, or that was
Yes.
really?
Yeah.
Wow.
Well, state of Texas is lowering title rates by 6%.
Wow.
Yeah.
I wish there was a credit report commissioner, because that seems to be the highest closing cost now. I think it rivals a title insurance premium, but that is interesting. I'll have to look into that. That's new. And you're right. When things like that happen, others go, I wonder. I could see Washington do that easily, start to control pricing.
Yeah, it's really if you've not to get off on a tangent here, but if you've spent any time engaging with insurance commissioners or participating or watching NAIC, National Association of Insurance Commissioners, the applicability or the means with which insurance commissioners regulate rates and practices varies dramatically state to state. Insurance is regulated state to state. Some insurance commissioners look at the title insurance industry and say, I'm not going to bother because that's such a low percentage of my premiums. The insurance basically is paid on a percentage of your premiums. And so title insurance and premiums compared to life insurance and homeowners insurance, very low. And so in some states, we don't get any attention at all from the insurance commissioner.
Wow.
So we will see. We'll see how uniform it is and how broad-based it is.
Wow. All right, let's talk about why title costs can be high. Specifically, I want to talk about the runoff from fraud. What's been going on in your world, because you're obviously insuring the title on the property, and you've also got escrow where you're closing these loans. Fraud's bad.
Fraud is unbelievably bad, and it is the biggest. Fraud and forgery is the biggest source of losses right now in the title insurance industry. And part of that is through automation has become very easy, if you will, for a bad guy to look at a vacant piece of property and position themselves as the owner and refinance it or sell it. And this happens, we confront this, I can't tell you how many times, but it's thousands of times a month.
What?
Yeah.
Thousands a month.
Thousands a month nationally,
gosh.
yeah. We get burned occasionally, but we really have put a lot of time, effort, and money into training our staff on what to look for, to verify things, and to be really, really careful, because this is the biggest source of losses we have right now.
Wow.
Fraud and forgery, yeah. And in the industry, it's the biggest source of loss.
So somebody trying to buy a house right now, you see one pop up on the market that was vacant, you should go, is this real?
Well, I think you need to look at it, but houses typically aren't the problem. It's usually vacant property. That's the biggest issue. Vacant
Selling
property.
somebody else's land.
Yeah. That's the easiest thing to. If you're a bad guy, that's the easiest thing to manipulate in terms of property.
And you're in it at that point, right? Like, you're losing on those deals because you've insured the transaction.
Well, no, we don't lose because we've insured the transaction. but we will lose if we facilitate someone using fraud or forgery to refinance it or sell it, and we close it. Then it's our problem.
Jeez.
Yeah.
I did just get an email saying that my closing docs were ready. And so for anybody watching right now, it was a California title company. It wasn't real. I'm not refinancing or anything on my house. And so when I got it, I'm like, well, obviously this is fraud. You know, I didn't even think to click on it. But if I was in the middle of a transaction, I might have clicked that thing. And so it's just, as always, don't click on anything, because a lot of that runs through fake title emails or fake real estate emails looking for your wiring instructions.
So we advise every client that we will never send them instructions on sending money or doing things like that. It'll all be done verbally. And we do that specifically to avoid someone manipulating or use fraud and forgery to scam dollars. But it still amazes me. We probably put that out in writing. We highlight it in red ink on instructions. We repeat it multiple times, and yet people will still respond to online fake instructions.
I think we've stopped reading sometimes. So the good news is you put it in red, like bold red. I will read bold red when I see it. Like it just, but it definitely is, it's that almost a laziness of, I'll just do whatever. And then they do it. I love that you do it all verbally, because that does just save so much pain for everybody involved, because people could lose money. I had a buddy wire $2 million and it was a scam, and he caught it right before it went out. But it was so legit. It was an email that he got from the realtor. It's time to, put your money in. And it looked completely legitimate, but it was not at all. And because it was, as soon as he looked at it, he made the phone call and said, hey, I just did this thing. Like, do I need to worry? Was that you guys? They're like, that wasn't us at all. And so because he made the phone call, he got it figured out. But
we work with banks. The industry as a whole has done a good job of working with banks and creating an environment in which there is a little bit of time to shut down a fraudulent transaction. It'll vary by location, bank, and circumstance, but by and large, we have a little bit of time if someone realizes something is amiss.
all right, let's what I want to do in the future, because we're doing these quarterly, and I think and maybe after 4 or 5 of these, I want to go back to each time we talk about AI and see what we knew at the time as we're talking about it, because it feels like every day I'm on an AI demo with a company that's created something. AI is my biggest concern right now for the mortgage industry. It's my biggest concern in real estate. The speed at which people can take people's money and commit fraud and send out all kinds of scammy texts. And it's just, you could do it with the press of a button now. And so I just saw a guy say he thinks with AI, you're basically not going to be able to use text messaging anymore, because so many texts come through that are just automated through AI. It's like, send a text to everybody saying the following, and it's just so many scams. Where's AI doing a good job in the industry right now?
Well, we're actually pretty, we have a tech subsidiary, and they've put a lot of time and effort into using AI to take time and cost out of the process. One of the things that's just very simple that we did early on is automate buyer and seller packages. And that's saving us 30 to 40 minutes a transaction.
Wow.
Yeah. Now we have 8 other projects, 8 other formal initiatives going on using AI to take time out of the process. And if you think about going back to my earlier comment about 45 days, one of the positives, and I know we're all worried about the downside of AI, one of the positives of AI is that we could very much simplify the process and make it much faster and share information. Now it has to be regulated, it has to be governed, it has to be used intelligently. I do think we would be a little bit more comfortable if there was more federal regulation around AI. Mm-hmm. I'm a little bit worried about the lack of oversight, but it is having a meaningful impact on saving us time.
Yeah. Time and money?
Time and money. Time is money.
Yeah. Yeah, I just saw it. I was on a demo today, and it's an AI tool that overlays over the other tech you're paying for. And so it makes you more efficient, but it's not replacing the technology you're already paying for. So we're seeing kind of an interesting way some of these tools are being used, where we were promised you'd be able to save all of this money and everything would be better. I think it's just taking a little bit. There's a basic law in technology that we tend to overestimate the impact of technology in the short term And we tend to grossly underestimate technology in the long term. So when AI first came out, it was like, it's going to do all these things right away. And then somebody, it can't even add 12 plus 12. And so then you get these naysayers, like it's really not, we thought it would do a lot. Now it's not, but there's some revolutionary game changers that are coming out. I do wonder what it does to jobs over time. Are there jobs, especially white collar jobs, that go away? Does it make us so efficient that we're able to lower some prices on some things? Does it affect closing costs?
Well, when ChatGPT came out, I dusted off my books on the Industrial Revolution.
Yeah.
And succeeding technological, periods. And what we see is that the average purchasing power of an hour of work goes way up. And inflation is sort of a monetary phenomenon, but how much you get for an hour of work improved. So people were all of a sudden in old England having 2 sets of clothes or even 3 sets of clothes. Think about that when you go into your closet. And I think that we'll see that. But there's also a change. There are always some people who have jobs that are really good and they're really well suited for that go away. And the young people I don't worry about. The older people, a little bit slow to adjust, learn new skills. So there is going to be cost to this. But I think we're going to see that people's living standards are hugely higher. And the way it's happening is not really through ChatGPT or Claude or Gemini, a little bit. But what's happening is these specialized companies are looking at a particular process. Gee, I know all about this one little niche, and they get the AI to make that better. And the end user won't know anything about AI. Yep. The end user will just say, oh, I use this program, do this.
Right.
If I can add to that, one of the things that you don't hear a lot of conversation around is our aging population.
You're talking about
I don't
me?
know anybody in that population. Yeah.
And then, we will be going negative without immigration. We'll be going negative, I think, in 2033.
Yeah.
And so AI actually may be a boon for that problem, because if you look at our workforce right now, it's very heavily weighted on the upper end.
Yeah.
Yeah. Mm-hmm.
The concern I keep hearing is you've got, title, right? You've been in this industry for a lot of years.
51.
Right. You're the wisdom in title. When you stop working, we depend on the knowledge you've passed down to the next group. And so when that group of people have a question, they're asking you that question. You've always been able to answer those questions. And so you've raised people up. If we start delegating some of those smaller things to AI and we lose the wisdom when you retire, where's the wisdom gap? How will we know when something's wrong?
Well, we're having that issue because of work from home already.
Oh yeah. Yeah.
The pandemic already caused that problem, but I think that is a genuine concern. I really do. Mm-hmm. And leadership is going to have to think this through, provide training and sources of information and education, because it will be a problem.
Yeah. I also wonder about this next generation. I was just asking ChatGPT something the other day, and I always talk to my ChatGPT. And I was asking a question, and my daughter walks in and she's like, do you have any idea how many gallons of water you just wasted? And I went, what? And this is a new generation thing. There's a backlash against AI where the younger people are like, you're not wanting to go look something up. And because of that, you decided that you're just going to waste all of our water and all of our energy. And it's like, oh, that backlash will be fun to watch. Them telling me I'm being lazy is new. That's right. A new twist. I heard recently that something was done about all of the investor purchases of homes. So you've got people like you and me buying houses, and then you've got these giant funds that go out and buy houses, and that happened a lot. And I've seen a lot of concern over, well, if they just move all those at the same time, we could have problems. I've seen concerns over, by doing that, they basically took out homes that other people would have bought, and therefore, hurt affordability. Talk about that a little bit.
Well, I think it was overdone, overemphasized by the press. I think the peak investor purchasing it hit 11% of all homes 1 month.
11?
Yeah, that was the high as it got.
Wow.
Yeah, so the amount of homes being sold, it's always been a fairly minimal amount. There may be certain markets at certain times where there's an impact from a major investor dumping their homes. But I don't worry about it being a significant factor on the overall industry or the overall market.
So this is a good headline, but it's not
And so it's to me, it's much ado about nothing, to be honest with you. Yeah.
And one of the positive things we've seen is that a person who wants to live in a single family home has more opportunity to rent than before. It used to be kind of rare, and now it's common, and in some communities, the whole community are renters. And I think having more options for people, it's not right for everybody, but for the people it's right for, let's let them have it.
And be honest with you, if you rent an apartment, you don't think about buying an apartment. If you rent a home, you do think about buying a home.
Right.
So I think it's a positive in some ways. Yeah.
All right. I've got one last question, Bill. We're going to dive into the day-to-day, daily life of Bill. So much of how the economy goes is based on how people feel, right? If I feel scared, I'm probably not going to buy. If I feel great, I'm probably going to buy. How do you even, you mentioned earlier kind of jokingly the psychology of it all, but so much is studying society and the way society reacts, right?
Yeah. I monitor the consumer confidence index. There's a consumer sentiment index. And I tried to develop econometric models, equations that would predict those. And what I learned was that most of the time, if people have jobs and inflation is low and interest rates are low, they're happy. And, some people are grumpy, but, jobs, low interest rates, low inflation makes people happy and makes them spend. But there are some unusual times where that relationship doesn't work. So the first Gulf War, American troops in the Middle East, 9/11, threw everybody in a tizzy. So I like to use those surveys for weird, abnormal things that nobody expected. But for everyday work, people will be happy if they've got jobs, low inflation, and low interest rates.
So absent chaos in the news, the fundamentals are the fundamentals.
Jobs, low inflation, and low interest rates.
Which is why you said those are the things you should be watching for.
Over and over and over.
Gotcha.
Can I repeat myself?
Yeah, I love it. And interest rates, I do see more and more people sharing that interest rates have dropped. It feels like when interest rates go up, people start talking about it. Yeah, the interest rates are high. When they go down, I want to see more people saying, does anybody know that we're actually doing a lot better than we were? Because last I heard some people on social media, it was 8. Yeah. And I think some people haven't posted about rates since then.
Yeah, and if I may throw a question out.
Yeah.
People have a memory of their 2 or 3% mortgages. They maybe have them or they missed that opportunity. Is that affecting people today? If we had not had that experience of really low mortgage rates, would people feel differently about their 6 than they do today?
Oh, yeah. I think so. It's that, FOMO, that fear of missing out,
right,
if I get rid of my 3% and yeah.
I think that, people are still aware of it and still thinking about it. And so it is having some effect. Maybe rates will come down. But I think people are starting to realize that was an aberration caused by the Fed spending 9 years with quantitative easing. Mm-hmm. That's not going to happen again, right?
I agree with you.
The $200 billion that Trump allocated to buy mortgage-backed securities. Is it mortgage-backed securities? Yeah. That had a really teeny little impact. What did the Fed spend? Like 2 billion or something? A lot.
Yeah.
So that was an aberration. It's not going to happen again. It just isn't.
And I think we have to get that message out there more. You're never getting back to 3. Enjoy what you've got. Do you want to move?
Yeah.
Can I share this with everybody? My first 18 years in the business, mortgage rates never got under 7.5%.
Wow.
From 1975 to 1993 before they finally got under 7.5%. Now, the cost of a home was a lot lower, so the affordability was better. But, when they finally went under 7.5%, we were all stunned.
Yeah.
After 18 years, so.
Yeah. Well, it's all perspective, right?
It is.
So, all right, it's time for final remarks. So going into Q2, what remarks for the people do you have? What, warnings, concerns, exciting things, what's your final thing you get to say to the people?
Well, as an economist, I'm going to say something a little unusual. Don't pay that much attention to the economy. serve your customers, serve them efficiently, keep your top employees around and encouraged and motivated. That's the most important thing. Now, you do have to keep a little bit of an eye on the economy. As we said, talk about, focus on jobs, inflation and interest rates, but mostly it's about serving your customers and keeping your great employees.
Love it.
I would echo Bill's comments and then also encourage everyone to make sure you have a business plan. I mean, the market could go any one of many directions on you, but if you have a business plan and understand that planning is a dynamic process, you can update it and change, but make sure that you are running as efficiently as you can and you're focused on how you operate. Those are the things you can control. I'm a bit of a stoic philosopher. Know what you can control, spend your time and energy on things you can control.
I love it. With that, we will see you next quarter. Thank you for joining us, gentlemen.
Thank you.